Hi guys and welcome back to a new video on Honest Chain. Today we will do another market analysis, so let's check out where we stand in June. Before we begin, quick disclaimer, I'm not a financial advisor and this video is not financial advice, and as always you should do your own research before participating into the crypto market. So let's start with the big picture. Where is Bitcoin right now? To truly understand what is happening right now in June 2026, we have to start with the absolute foundation of the entire market, Bitcoin. Right now, Bitcoin is trading in a consolidation zone around the $64,000 mark. Now, if you just look at the headlines, you might think the sky is falling. Bitcoin has taken a roughly 50% dive from its massive all-time high of over 126,000 that we witnessed back in October 2025. Just a couple of weeks ago, on June 6th, the price actually bottomed out at around $61,500. If you take a step back and look at the entire crypto market capitalization, which is just the total dollar value of all cryptocurrencies combined, the market has shrunk by around $2 trillion from its absolute peak. For anyone new to crypto, seeing trillions of dollars vanishing can feel incredibly terrifying, but if you understand the broader economic cycles, this is actually where the real story begins. So why are we seeing this massive pullback? If crypto is supposed to be decentralized, why is it dropping? The easiest way to understand this is that the crypto does not exist in a vacuum. It is heavily tied to global liquidity, which is just a fancy word for how much cash is floating around in the world economy. And the person who controls that faucet is the US central bank, known as the Federal Reserve. Recently we had the highly anticipated FOMC meeting on June 16th and 17th, so the Federal Reserve decided to keep interest rates steady between 3.5% and 3.75%, and that part was expected. But what caught the market off guard was their forward-looking stance, which Wall Street calls the hawkish signal. Out of 18 Fed officials, half of them are now projecting that they might actually raise interest rates at least one more time before the end of 2026. When the interest rates are high, borrowing money is expensive, and big institutional investors can earn a safe guaranteed return just by leaving the cash in government bonds. Because of that, they pull their money out of volatile high-risk assets like crypto. And this is exactly why we saw a massive $2.43 billion pulled out of Bitcoin ETFs in May alone, and why another $111 million left the major crypto ETFs in a single day right after that Fed meeting. The big players are temporarily moving to the sidelines. But here's where things get really interesting, and why you shouldn't let panic-selling headlines dictate your strategy. On June 10th, the latest inflation numbers dropped, and they actually contained some fantastic news for the long-term health of the market. The standard consumer price index came in at 4.2% year over year, which matched what analysts expected perfectly. But the core inflation rate, which ignores highly understandable things like food and energy prices, actually dropped to 2.9% year over year. That beat the monthly forecast. In plain English, this means the Fed's aggressive strategy is working and price hikes are slowing down. If inflation continues to cool off like this over the summer, the Federal Reserve will eventually be forced to stop threatening rate hikes and actually start cutting them. Historically, the moment interest rates start coming down, global liquidity floods back into the economy, and that acts like absolute rocket fuel for risk assets like Bitcoin. Now let's pivot to the altcoin market, because this is where everyday retail traders are hunting for opportunities, and it is also where the volatility is the most extreme. Right now, altcoins are bleeding heavily against the macroeconomic headwinds. Look at Ethereum. It is currently trading at around $1,690, and to put that into perspective, Ethereum needs to pull off an 18% price jump from here just to reclaim the $2,000 level. Solana is sitting at an even deeper through, trading near $64 per piece, which marks a brutal 70% drop from its cycle peak. For Solana to get back to just the $150 mark, it would need to rally by roughly 119% from its current price. But if you are a smart investor, you don't just look at the price chart, you look at the network activity. And this is the exact shift that caught our attention this month. While the asset prices are down, the actual usage of these networks is breaking records. Solana, for example, is currently operating as one of the most heavily used blockchains in existence. Even in this down market, the everyday retail community is keeping the network buzzing. People are actively trading, launching decentralized applications, and participating in meme coin ecosystem because the network is incredibly fast and the transaction fees cost less than a penny. The exact same thing is happening on Ethereum's layer 2 scaling networks. The infrastructure is being battle tested, developers are still building, and long-term crypto holders actually accumulated over 125,000 Bitcoin in the month of June alone. And this tells us that while short-term speculators are panicking and selling, the biggest players in the game are quietly buying up the supply at a discount. So if you are new to the crypto space, the single most important lesson you can take away from June 2026 is patience. Right now the market is is playing massive game of chicken with the Federal Reserve. We are in a structural consolidation phase where prices move sideways and downward, shake out weak hands before the next major expansion. The immediate support zone to keep your eyes on Bitcoin is between $61,000 and $63,500. As long as Bitcoin holds above that floor, the macro structure remains completely intact. If it breaks below that, analysts are looking at a potential slide down toward the $55,000 level, which would simply represent an even deeper discount for long-term accumulation. Don't let the 24/7 price chart stress you out. Focus on understanding the technology, monitor the real network usage, watch global inflation data, and always stick to disciplined strategy rather than emotional trading. Thanks for watching, and I will see you in the next video.